Good afternoon, everyone. We actually are less one person, Jonathan Bach, today. He had promised to be here. If he comes in, we are going to ask him some questions, even if he doesn't join us here on stage. But we've all decided that we're actually going to try and be Jonathan this afternoon. So in order to get started, I'd like everybody to take a few minutes and introduce themselves, and then we'll get on to the topics. Matt?
Sure. So Matt Giordano, I'm a partner at KPMG. I help run our public investment management practice. Also, in my former life, about 6 years ago, I was the chief accountant in the Division of Investment Management, and also sign on a couple large BDCs that are in our practice.
Al Laufenberg with KBW Stifel. I lead the BDC investment banking practice for the firm and have done so since 2005. So a while. I used to be the youngest person on these panel discussions. I'm not anymore.
How many BDC roundtables have you been to?
It says 5, but I think I've been to probably a lot more than that. Maybe I snuck in. I'm not quite sure.
Maybe that was it.
I think so.
Cindy Ma, with Houlihan Lokey in New York. I'm the Global Head of Portfolio Valuation and Fund Advisory Services. And I've been with Houlihan for 16 years. And prior to that, I was a partner at Ernst & Young and also a derivative trader for a number of years.
Stephanie Hildebrand. I know a lot of you in this room. I am a partner on Evershed's BDC team. I've been working with Cynthia for, we'll just say, over 10 years now. We're not going beyond that. So
I was actually at the first BDC roundtable, but I usually don't go over 20 years, but I'll say I've been working with BDCs for about 25 years with Steve. So we're very excited to get off the conference today. And one of the things I need to do first, which I know everybody's in the support are asking me when I'm going to do this, but we do have the polling. It's on your iPhone. So if you go into the app, it says polling, and we're going to ask about 10 questions during the process. This really is, we want to get people's reaction. One of the things that we do is we take away what we hear here and talk about what we can do to improve the industry, move the industry forward, and all of that, those types of things. So we want this day to be the interactive, where we started with the roundtable when we were all around one table. So, and we'll basically be feeding the questions or the answers out as we go along. They are not going to let me do it though, so I get to put my phone down. So, just to get started, the first question, and Al, I'm going to go to you, and then anybody else can jump in, is, how's the BDC industry changed in the past couple of years? Where do you expect us to be 6 months or a year from now?
Sure. So obviously the market's evolved a lot, just the credit environment with the interest rates going up and all of that. Clearly that's created an environment where the publicly traded BDCs have been challenged to trade above NAV. And so you've had a large number of large platforms consider and very successfully raise money through alternative structures, not through the public side, either non-traded, private, or the multi-class system. So we expect that trend to continue. There have been some exceptions to that, of course. And we've been involved with a number of those IPOs. But it's hard to take a company public in this environment. And then it's even harder if you're a BDC. And so those are kind of the things we've seen over the last couple of years. And then what I would say over the next 6, 12 months, everybody's focused on asset quality. Everyone is focused on earning assets. And can you sustain your dividend? And so if you look at publicly traded BDCs as a bogey, vast majority of trading at a discount to NAV. And I recognize people are going to say, well, that's unfair and we're undervalued, and you're right. But at the same time, the cynical investor will say you're trading at 92% of reported NAV, but you're probably trading around NAV once we get through this economic uncertainty. And so the market is pricing in further deterioration. And so that's going to be the story for the next 6, 12 months. The vast majority of you are going to announce fine earnings, and it's going to be just fine. But there's going to be a hiccup or two for some BDC, and that stock is going to get pummeled, relatively speaking. We'll be down 5-8% in one day. Why is that? Because people are fearful of what else will come. And then if that anybody who looks and smells like that entity will get further questions. So if you compete against that entity, people will be asking, well, are you the next one? We're in the environment where people sell the stock and ask questions later. That's the environment we've been in certainly in the last 3-4 weeks since Silicon Valley. And we expect that uncertainty to continue. And then we can all have this debate about the recession and everything else, and deep, and how long, and when, and all those other things. So those are my thoughts on what's going to happen over the next 6-12 months. It's a fascinating time period, unless, of course, you're trying to raise capital.
So the first polling question is, what do you think is the most significant challenges facing the BDC industry? Inflation, recession, cyber, liquidity, AFFE, ESG, or the instability in the US banking system? And I think although they promised I could read it from here, Stephanie, it's on the screen, and as you answer, it'll show. Oh, there, now I don't have to stand up. Perfect. So inflation, you were suggesting that maybe it was the banking. We have to get past that first.
So I think inflation and interest rates are clearly the key driver. But over the last 3 or 4 weeks, there have been moments when if there's not going to be another bank failure in the next 3 or 4 weeks, that instability is going to slowly diminish. And what we've seen the last 3 or 4 weeks, I'll put it this way. When you turn on CNBC or Bloomberg television at work, you do not want to have a financial services company be highlighted throughout the entire day. That's not good for the space, for any lending institution. And obviously when Silicon Valley failed and then Signature failed, you had a mindset of who's next. And then Bloomberg or CNBC were showing the different stock prices going down and all that stuff. You're not seeing that as much today because that feels like we're getting past that. So as long as there's no more bank failures over the next 3 or 4 weeks, the market will say, well, that was a unique set of circumstances, crypto-related, et cetera, uninsured depositors, that sort of thing, unique situation, you're moving forward, and then everybody's going to be focusing on inflation, interest rates, and recession. If there's another bank failure or two, then people will say, wait a minute, this isn't just 2 or 3 banks that had crypto exposure. This is something bigger. And then you're going to get a lot of questions about liquidity and everything else. BDCs have ample liquidity, generally speaking, so that's not the issue. But anytime you have fundamental questions on the foundation of banks, it's like somebody sneezes and everybody else catches a cold. If banks are unstable, then the venture lenders, the BDCs that make loans to things that banks don't do, the perception is, okay, we've got a bigger problem in those areas, and they just haven't figured it out yet. So very fluid environment, which makes it exciting, but also a lot of opportunities at the same time.
Well, it appears that everybody's agreeing with you between the 36 and 25% for the inflation and recession. Anybody else want to add anything to that? Matt?
I just think it's interesting, right? If you came up here a couple of years ago, think about my time on the staff and shortly after, AFFE, we spent so much time talking about AFFE, and that's down to 3% just with everything else that's going on. And that's even lower than ESG, which kind of surprised me. I'm kind of surprised we see some of the ESG reporting up here. I agree with what Al had mentioned about the inflationary, the inflation, interest rates, and recession. I kind of think about some of those together. I think from the private credit side, what we're seeing is some of the loans that were made, a couple of years ago. You really watching the quality of those underlying portfolio companies and those loans. What we're also seeing is some of the loans that are being made now are in really good shape, right? So I feel like folks that are getting in now from an investment standpoint, there's probably better quality or better origination around those types of loans.
So just to go on the next question, Stephanie, I'm going to ask you this. How have you seen the BDC industry change? And do you think you work with a couple internally managed folks and externally managed? Any idea which way we're going?
I think every once in a while there's a pop for a lot of discussion around internally managed. I think Al would probably agree that people like the concept of it internally managed. That said, I think with the externally managed product, it allows the management teams to do so much more, to diversify outside of just the BDC when they can get their co-investment relief and build their platform beyond just the focus on the BDC. I think to the extent we see more activity in those internally managed BDCs that have the relief to have an advisor under their structure, I think that provides those internally managed structures with a little bit more flexibility to compete with the private BDCs and the publicly traded BDCs. So I think watching that and how that progresses, I think that's really going to differentiate BDCs themselves and the platforms, right? Because I think it's more about the platform now than an individual BDC, especially even when in the externally managed structure, where it used to be you would have an external manager and a BDC, and that was the platform, where I think that's just no longer the case anymore. I think you're seeing larger platforms get into the BDC business, and what started out as smaller platforms growing and expanding to meet all those different product needs out there.
And Al, anything you want to add to that? I mean, you've dealt with both.
Yeah, so a few thoughts. One is on the externally managed side, coming out of the financial crisis, there were lots of folks, I'll put myself, if I was unemployed and I happened to work with 3 former colleagues and let's get the band back together again, and we could form an externally managed BDC and take it public. We could do that. You can't do that today. And one of the reasons is just the asset class. Most of the BDCs now, and are correctly so, are investing in first lien, and scale matters. And you need diversification within your portfolio. So as a result of that, you need to have a large platform that you can co-invest with. Back post-financial crisis, there were BDCs doing sub-debt. So you could do a $10 million tranche and be meaningful and reasonable and get good market share and get good outsized returns. Today, there's a few subsectors where that's an outlier. But the externally managed vehicles, it helps. Name recognition matters. Investors always want to invest with smart money. And for lack of a better phrase, sometimes scale automatically translates into perceived expertise. The view is, hey, a $40 billion AUM shop must be pretty smart. Otherwise, how could they have raised that much money? As opposed to, like the internally managed models, some of them are here today. They're very successful, but there's really only a handful. And so it's just a very small subsector. I personally think when you look at the internally managed model, investors love the internally managed model from the standpoint of economies of scale benefit the shareholders, whereas you can't always make the same comment about the external managed. So we've underwritten internal and external both. So, depending on which argument I need to make, I can probably make it. But nonetheless, what I would say is the internally managed model has some real benefits, but there's some real cutbacks to that as well. For example, when an internally managed BDC goes public, a lot of investors say, well, that's great, but I want to come in at NAV. Well, there's no external manager to help subsidize the gross spread. So how are you going to take it public, and who's going to bear the costs of the gross spread and the attorney fees and the investment banking fees, which is a bigger component of that? Those are all questions that people say, oh, yeah, that's right. I have to come in at a premium to NAV. Well, I don't like that. So those are all key questions we go into. So at the end of the day, we see a lot of talk about internally managed, but it doesn't really work. So we see most of the backlog being externally managed entities, part of large platforms, well-named recognition on Wall Street, and to some extent, well-known on Main Street. Some names that are big names. So when people see it, they'll be like, oh, of course, they're taking a vehicle public, and there's an automatic acceptance of that entity. So that's what we're seeing and what we expect to continue. Clearly, the non-traded, the private, the multi-class, it's diversification for the manager. There's going to be a point in time when it makes sense to access capital through the public markets. It's great. Talk to Ares, doing a $250 million equity raise, overnight, and then wait 3 more months and then do another one, and maybe wait 6 more months and do another one. That's wonderful, but that's not the norm. And so you want to be able to have any manager should be diversified just like you are with your personal portfolio.
And I'll just add to that. I think Al mentioned, non-traded versus private. I think to the extent the SEC does finally grant multi-class relief to private BDCs, I think that's going to open up the entire fundraising market for those private BDCs. I think it'll take market share from the non-tradeds because it's structurally and regulatorily, it's an easier platform to raise money on, or maybe not raise money on, but to deal with the registration and getting from day one to launch. So I think to the extent we see that, whether it's, I think we're hoping for an update from the SEC this week on where they are. We'll see what happens. Those clients in the room that have those applications in, sorry, we're trying. But I really think that's going to make a really big difference in the BDC market going forward.
Well, and one of the polling questions we have up now is which is the most, which do you see the most interest growth potential for BDCs this year? And you still have the non-traded eking out at 25%, not to mention the 21% for the multi-class non-traded. So the question is, will that flip or will it go back? Because if you look over the last 5 years, the privates actually, I believe, have raised the most money, and they haven't had access to the multi-class. The question I guess I might ask is, do you think the wealth channels will go to a private versus the non-traded? I don't know if anybody...
I think they will. I think it's a way for those investors to get access to this product.
And then I would just say that there's been a lot of discussion about permanently private, meaning not seeking out a liquidity event or a listing. I am curious to see how the markets actually see that, because I do think that there's still a number that are seeking out listings as a result of the first non-tradeds that came out. How do you see the listed market play out? Is that... We're going to see an uptick in that?
I'll jump in. A couple thoughts. One is there's a class of investors who want to invest in something that you can't just have anybody buy. And so there is some features of the non-traded, the private BDCs that's very appealing to them. High-end financial advisors within our system and others want to be able to provide unique opportunities for billionaires that they just can't call up Charles Schwab and buy some publicly traded entity. They want to be able to say this is special and this is only available over the next number of days with us, and then that sort of thing. So I think that's one key component. Two, the family offices and pension funds don't want to invest in public securities. It's not really their mandate. So what you're seeing is creative folks at Eversheds Sutherland and other places trying to find the practical solution. And what you're seeing is just simply a function of, okay, there's a lot of capital available outside the public world. And how do we match that? And so that's what you're seeing. And then the structures and all of those sorts of things, people on the far ends here are true experts about the structures and the nuances and the benefits of each. But at the end of the day, all this is just matching up an asset class and tailoring it to the type of investors and whatever one matches up with. Our typical investment in an IPO, we'll sell $25 million in our system of 2,200 financial advisors. The median average ticket, about $25,000. That's a lot of tickets to get to 25 million. And that number's been pretty steady for 15, 17 years. Do we have orders of $1 million? Sure. Do we have orders for 10 million? No. If it's 10 million, they go into a non-traded, private kind of structure. They don't want to pay, they want to be involved with something that everybody else is doing. So that's what we're seeing in our system, and that's pretty consistent across the spectrum. So people who put in $25,000, they're first-generation wealth builders. That's the public securities. That's different asset classes, different investment thesis that's appropriate depending on the situation.
Yeah, the one thing I would say too is you see the private BDCs contemplating a listing or a liquidity event. I think for those BDCs that have an entity out there that's public that is sold at a premium, right? There's this great opportunity, especially from a marketing standpoint, to say, okay, not only are you going to get this yield, but you're really going to get the upside when this thing, like our flagship BDC or like our BDC that's selling above NAV, pops. You know, we expect the same sort of premium, or it's at least inferred.
Agreed.
So we hear that.
It's going to be a very, very interesting time, but let's shift a little bit over. One of the things that makes BDCs tick is the SEC. As we've all seen, the SEC has been on really moved quickly and aggressively with a lot of rulemaking. I think that there's over 50 that are kind of waiting in the wings, 29 of which are ready to be kind of sprung on the various BDCs and their boards. And then you had the chairman come out and say that he wanted a 12% increase in the budget. He wanted 100 more people, most of which will go to enforcement. Matt, how do you see this playing out? Do you see this continuing? Do you see these rules with the cyber, the ESG all coming into play, or where do you see that?
Yes, yes, and yes, right? So I think what's happening, and I hosted a webcast with the SEC this morning, and it's just absolutely clear to me that there is no slowing down from a rulemaking perspective. You know, they'll be up here. I think it's a good question to ask them. I think that there's certainly an agenda. I think if you think about the SEC, one of the most important things about the SEC is that it's an independent agency. And I felt like when I was there, folks worked across the table. You tried to be collaborative. You listened to the commissioners, even if you weren't getting their vote. I don't have that feeling in this administration. I mean, you see a lot of 3-2 votes. You know, custody was 4-1. Even the 5-0 with the tailored shareholder reports, which is a mutual fund rule. There were the 2 points that were put out was, you know, the change in 30E3 and AFFE for BDCs, right? So both Peirce and UEDA had mentioned that. I think that the focus will be rulemaking. I think the focus will be enforcement. There's clearly, I'm trying to phrase this the right way, the exemptive applications or no action letters that the industry relies on, I think are taking a back seat. And I think that they'll continue to take a back seat through this administration. I mean, some of the stuff that you think, this is a layup, this is gonna get through, not going to held up, very investor friendly. You can't even get some of those things through. I mean, I was really surprised the multi-class hasn't been pushed through. I mean, you think about all the potential benefits there, but.
And no real reason why, right? So maybe more resources will be helpful, but I do think that there's an agenda with both the director and the chair that they really want to get after the cyber, the ESG, things that maybe are not necessarily at the forefront of everything that this group is worried about. So just to talk a little bit about what's happened over the course of the past year, we had the new valuation rule, the 2A5, and we had that coming into play, and we've got some questions about that as well as to how much that changed your process, because it didn't really change how you fair value. Right, Cindy, anything you'd like to say about how that process came about, what people are doing, and then the polling? These you can actually mark more than one if you've done more than one.
Okay, sure. I think everybody is familiar with 2A5, so I don't think I need to repeat it. But basically, I think under 2A5, it focused on the and the fair valuation of the investment held by the BDC. And first is, I think it's good news to the board, right? Because they actually will be allowed to assign a designee to help them with that process. And second is the 2A5 also want to make sure there is a consistent framework to develop, a baseline valuation for all the funds. So what is actually very interesting is because, we do work with with a lot of the BDCs. And when the 2A5 came out, in terms of the valuation process and framework, I would tell you that I think it's like 95% of the clients are actually already doing it. So it's like, not a surprise to them. But what is actually is good is like, certain clients actually comment on the fact that because the board actually now they don't need to know the nitty-gritty of each of the investments. So instead of sending like a book of 1,000 pages to the board members, and now they're able to to streamline the process and be able to send out summaries and schedules, especially kind of to help the board to actually focus on the investment that is actually have the biggest change from quarter to quarter, or investment that consider high risk, or investment that's considered distressed, challenging. So it actually helped the board to focus on the things that really matter. And for investment that basically they don't change quarter to quarter, or belong to the industry that actually relatively stable, they actually tend to be able to put less time on it. So that is actually the welcoming part, for our clients. So we also actually get requests from our clients. It's like, can you help us to kind of prepare the package that will that can go to the board, and help them to to review it. I think that is actually a very welcoming change. And the other part of the 2A5 is also talk about they don't. I still, especially for level 3 asset, I always said it's it's part art and part science. And so, if someone's saying that, you have to use this methodology to do the work, it really depends. If the asset is performing, it's easier. But if we get to recession, that would be more distressed asset. Methodology may change. And the good thing is I don't think the SEC being prescriptive about what methodology you have to use. But it's common sense. We kind of know that it has to be economically sound. It also have to consistently apply. You can't really cherry pick the result. And so from that perspective is we're actually getting more requests from clients to revisit their valuation policy and procedures. And because I actually have been working for the SEC for the last 14 years as a testifying and consulting expert on a number of high-profile valuation cases. So, and also actually defend a number of clients with the permission of SEC. So I'm actually on both sides of the world. So when I talk to a client on valuation policy and procedures, I also want to make sure that don't be actually, one time a big firm got nailed by the SEC because they were so prescriptive. Their valuation policy and procedure so prescriptive, it became like a roadmap. The SEC, you didn't follow your own rule. So in a sense, but at the same time, your valuation policy and procedure cannot be that wide, right? It's just like anything can go through. And the last thing is I want to make sure that you don't copy somebody else's valuation policy and procedures, because it does have to reflect your own infrastructure. So right now, we're doing a lot of that valuation policy and procedure, and in view of the 2A5. And I actually believe that the best defense is have a really good valuation policy and procedures and actually apply it on a consistent basis, irrespective of the market condition, you have to apply it. And so, that is, I believe that that's your best defense.
Matt, anything that you're seeing?
Yeah, I actually thought, so I work with some BDCs who use the valuation designee and some that don't. I was kind of surprised. I thought everybody was going to go there, and I think even the ones that don't, sometimes counsel will still recommend doing that to somewhat isolate the board from a legal standpoint. And you don't see the SEC come after too many boards. You saw Morgan Keegan, which was that was like a real failure of kind of. That was a set it and forget it model versus what we see in a lot of the BDCs. But I think where we see potential items is actually not on the policies and procedures and not what's being reported to the board. And I do think people are reporting different things and different depths of information. But one of the things that the SEC has come out and said is that when you read the financial statements, you're not mentioning that there's like a valuation designee, or you're not mentioning who that is, or your description isn't detailed enough. So you kind of change from what the board does to the designee, and it's not in your financial statement. So I would just tell people to keep an eye on that.
think you largely want to make sure you make that change because you don't want to be telling people that it's the board ultimately when it's really the advisor. Stephanie, I think, is there a reason why maybe you wouldn't want to have an designee?
Yeah, well, I think part of it is the way that the rule is designed, right? That you have to bifurcate the valuation duties from the portfolio management duties. So I think on some of your larger platforms where they have enough bodies looking at different aspects of the lending process, going from underwriting, origination and underwriting, monitoring to the exit part of the investment, you have enough bodies, you have enough people in the room, or enough people in different rooms to actually bifurcate those duties. And I think some of your smaller platforms where the portfolio monitoring and the day-to-day talking to your portfolio companies, talking to the management teams, that really comes into play in the valuation process when you're doing the valuations of your portfolio companies and you're getting their financial statements, but you're also talking to management and really assessing the business. I think for the smaller platforms, they really can't, under the rule, designate somebody to do the valuation. So there's you're a little bit stuck in that regard. But then I think there are some platforms where they could actually bifurcate the roles, and the roles may already be bifurcated just based on how they run their business. But I think sometimes the boards, they don't want to, even though it's giving up liability, where you think the boards are always scared of liability, I think sometimes the boards want to keep that piece in their bucket because it's their way of doing the oversight of the BDC, valuations being probably the most important thing, right? It runs your entire business. And I think some boards are reticent to give that role up because it's really how if they're getting the information and they're responsible for it, they believe the management teams are then going to provide accurate information so that they can do their jobs.
So I think there's still some, go ahead, sure.
Can I make a commercial here? Actually, what's interesting in the last 6 months, we have really seen a lot of volatility in the public market. And I mean, prices have gone down, markets have changed. And so we also have seen the growth equity, the unicorn space, right? Major markdown by the funds. So what we got a lot of calls from the reporters these days, and it's actually asking us is how come we look at the public filing by a lot of BDCs, right? We don't see they really mark down their portfolio. Can we rely on the mark? That's not only from the reporter, also from some of very sophisticated LP advisors. They have the same questions. So, we actually spend a lot of time to actually explain to both the reporters and the LP advisors to tell them there is really a big difference between public securities, public credit versus the private credit. Private credit bias, because a lot of times what you see, the liquidity, the changes in the public market, a lot of that really is due to the fact that liquidity actually affecting the marks. There's a lot of noise. But when you're doing private credit, it's liquidity cannot affect private credit because when you get into that space, it's just already illiquid. Nothing can make it more illiquid, right? They don't exit through the public market. So public market volatility should not really affect the private credit. So the reason I said I make a commercial here is because after spending so much time talking to people individually, we actually end up put out a paper. It just actually seemed that's very nice to have us posted on the website to talk about the uniqueness about the private credit and how that really affect the valuation. And I think what's going to be interesting is the market had gone down a little bit, but in fact this quarter, if you look at the first lien and second lien, the spread tightened. So for BDC that use a matrix approach to do the valuation, they may see a slightly marked up. But in general, it's the market has been relatively robust, maybe slightly down, and I think that caused a lot of interest and curiosity from people that are not in the private credit space. That's why we actually put that paper together and hope that to dispel But at the same time, we do know that why it's so robust, right? Because like Al will tell you that, I mean, there's so much money is actually chasing the private credit in that space. So when we talk to our clients, I say, do you think the market risk premium have gone up? They will tell you that, but I have so much money to deploy. I'm competing with people for the investment. So they're really lending at the similar spread. So they would tell you that when you look at the recent transaction, the spread relatively stable. And that's why the value have been relatively stable. And going back to the previous question about the interest rate and inflation, I think the portfolio companies have done a really good job right now to service the debt. So the next 6 months will be very interesting. It's like, is interest rate stay the way it is, or interest rate continue to go up? Will the portfolio companies be able to continue to service the debt? I think that is what we really need to watch out. And also that may be, if they're able to, that may be the answer to a lot of the critics about the stability of the private credit markets.
So I think just bringing it back to the rule is, I do think that because we did a survey beforehand and it had 50% of the folks doing valuation designees, and so now it's a little bit less. I think you're going to see some to and fro. Some people might be waiting. The one thing I would say is that the SEC is out and spoken about the important things that you need to be doing and where you need to spend your time, which is on the most significant changes, the methodologies, the procedures, and in speaking to boards, those are the pieces I think that they need to be taking time with and making sure their policies are in place, whether there's conflicts, whether there's, and backtesting. Backtesting isn't something that you talked about a lot when you're talking about valuation for BDCs. So I think some of those things that crop up are pricing challenges. Those are the types of things I don't think it makes any difference whether you're using a designee or not. And there was a time when we didn't have valuation experts on almost every BDC. And so I think that you're going to see a lot of this come together almost regardless of whether you use the valuation designee.
Yeah, I think one thing that just to kind of think about when you're thinking about valuation, right? You never get yourself in trouble if you're thinking that exit price concept. And I would always tell people that, right? Like, well, you know, maybe you're never going to sell it, but not changing the value, especially when you see deterioration in credit or spreads, right? And taking that spread into account. And that's what the SEC's almost more focused on. If it's within the range, you're probably fine. But really, how are you moving in that range as well? And I think that's a little bit of a nuance. But I think it's an important one, especially under this administration, to think about.
Exactly. So now just to move along to ESG. It's something you can't, look at a front page of a newspaper or get away from. And there's several proposals out there. And the real question is, how is this going to impact BDCs? I remember maybe 3 years ago, right before we went into the pandemic, I brought up ESG, and I'm not sure that everybody in the room knew what I was talking about. I think everybody knows now. The European folks are well ahead of us on some of this. And so we're, as far as the market or the industry, a little bit behind. But how do you think, Stephanie, how do you think it's going to affect BDCs?
So I think it's important to distinguish. There's two big proposals with the SEC right now. One covers public companies generally, which BDCs are public companies. Even if they're not traded, they're still public reporting. So you have diversity, you have ESG issues there. The SEC put it out on a really tight time frame, and now we've heard basically nothing other than, I think Gensler came out earlier this year and said, yeah, we're thinking about it a little bit, these scope 3 emissions questions and disclosure, we might have to think about that some more. The scope 3, of course, is the greenhouse emissions that everybody's bringing to you, your supply chain, your vendors, your customers, et cetera. The other one that I think will have a bigger impact and probably more likely to get passed sooner in some form is the ESG proposal related to investment advisors and funds specifically. those, really it comes down to providing more disclosure, both in the fund's prospectuses as well as PPMs, because the SEC believes that investors need to know more about what a fund is doing from an ESG perspective, and in particular, whether it is a fund that in its investment process just thinks about ESG a little bit, and it's a consideration but not a focus. And then there's the funds that say, yes, we are going to do X, Y, and G. We're going to take the E, the environmental, and we're going to make sure that we're investing in portfolio companies, equity or credit, that have this sort of focus, right? And then there's the impact, right? Those are the investments that we want to make an impact with our investing, and this is how we're going to do it. And at each level, the SEC wants to hear more, and it wants its investors to hear more about what you're doing, and the level of disclosure changes there. And so I think that is going to make funds sit down and think about what they're actually doing, and they can't just say, oh yeah, we're ESG, go ESG. And I don't think the SEC doesn't want that, right? They want legitimate disclosure that actually talks about what you're doing. And then of course there's, changes to the ADVs, which impacts the advisors and what they're disclosing about how their platform operates and what types of things they operate. So I think that is going to impact the industry, only because it's going to make funds and advisors sit down and think about what they're doing and make sure that their disclosure is appropriate and make sure that they're hitting the right topics.
Yeah. I don't think ESG is going anywhere. Interestingly, the pre-conference survey had people incorporating it into their investment process at 41%. It's only 20% here. I'm not quite sure what impacted that. I don't know.
We have an ESG panel after that, so we'll see how many people are interested.
There you go. So, Al, do you see, is this something that the investors are asking you about?
Yeah, so a few thoughts. I've been in front of boards where, there are some board members who think ESG is the most important factor. And then others are like, it's nice, but it's like number 6 or 7 on the prioritization list, Al. My view on this is I'm not here to pass judgment on where it should be on the prioritization list, but a few facts that everybody should just acknowledge. One is there's ESG dedicated funds. So if you're publicly traded, that's a pool of capital, pool of investors you can go after. So you want to be able to have an ESG plan that you can articulate. And the BDC model is such that it should be friendly on an ESG front. It's not like most BDCs are not lending to oil and gas companies and that sort of thing. So, there's a lot of things that inherently, it's about documentation. Second is that anybody who's going in front of a pension fund or anything like that, you absolutely have to have ESG. That is a core principle for them to make a decision. Yes, of course you have a good investment track record. Yes, of course you've got a great team in place. Yes, of course you're going to have great deal flow going forward. But what about ESG? So depending on your audience, it's going to have a bigger factor or not. So on a normal IPO, is ESG covered in most investor conversations? Maybe. Maybe a slide out of 20 slides. Maybe it's 30 seconds. If you're talking to a pension fund and being an anchor investor or setting up a JV with somebody like that, or a large insurance company, it's going to have a significant percentage of time dedicated to that. So to me, it's just a matter of who your audience is, and then you can decide what prioritization that is. So that's my view, and so it's real, it's going to stay here, and there's available capital. And so it's up to each party how much they want to embrace it or not.
Right, and the SEC came out this past year with at least 2 enforcement. So the smart thing to do is make sure if you're going to incorporate it, you need to incorporate it, and you need to make sure that your paperwork follows it if you're going to go after that.
Yeah.
And so it's going to be interesting. I think eventually ESG is going to have to be broken apart. It's just got too many pieces to it, because it even goes to diversity and a variety of things, because energy, diversity, big tent.
Of course, there's what all the individual states are doing.
Right.
I think I was talking to our colleagues in DBA earlier about the breakout session that we're doing, and she was telling me that I guess I'm stealing her thunder here, but the state of Iowa website was equating investing in ESG to terrorism. So, you have this extreme that, so depending on how the different state legislatures work, that is going to impact, and I think that goes to your point, Al, about pension funds and the state pensions, and that's going to impact how these funds are talking about ESG outside of the SEC.
So I'm going to go to a favorite topic, if you've already heard picked up, AFFE. And we have a polling question, and the question actually is, do we think that BDCs are going to be returned to an index if the SEC provides rulemaking? And I don't know what we're going to come out here, but in the pre-survey, we got 55% said no. And I think that might be a little discouraging because of the fact that the AFFE hasn't gone through the proposals or gone through the Congress or the SEC. I know there's a lot of discussion about it. I think, Matt, you mentioned AFFE, and I don't know if you think that there will be something put out or it'll be helpful.
I mean, I think I would have told you probably like 7 years ago we would have fixed this, 10 years ago that we would have fixed this, and it never got done for a number of reasons. I thought for sure that we would see it in the fund of funds rule, which they kind of tried to address and they didn't. I think initially there was a view that maybe they could have fixed basically the staff statement that said that you had to pull it in, right? And nothing has happened. So I definitely don't think we're going to see any changes under this administration. And we talked about, the Taylor shareholder report, 5-0 vote. 2 of the Republican commissioners brought up this specific topic as being an issue, and there's been nothing on it. I don't think you're going to see a change in the next couple of years.
So I think it's the legislature, which God knows there. But that's, and we'll let Tani and Brett talk about that tomorrow morning. But maybe we can go on to cybersecurity, and just there's actually 2 different rule proposals out there that would affect BDCs. Stephanie, anything you want to add about that? I mean, that seems like a little bit of an overkill. One's because they're a public company, and the other is because you have an advisor.
Yeah, I would agree. I think a little bit of overkill. And I think, generally speaking, boards are already focused on cybersecurity. Similar to you can't turn on the news and not see anything about ESG. You can't turn on the news and not see anything about, cybersecurity, the next breach or the next possible breach, or how to protect yourself. There was a report in the last day or so, maybe this morning, where somebody came out and said, don't plug your iPhones or don't plug your phones at all into the little USB ports in an airport or any other public setting. Someone's going to steal your data. Not because data has been stolen, although I'm sure it has been, but just beware. So I think that all falls into cybersecurity, and I think companies and boards are already really, really focused on it. So whether or not these proposals have a big impact, I don't know.
Anybody else want to weigh in? I mean, this is something that the board of directors definitely needs to be spending time on, which you'll see in the polling questions, and having someone come in and give you information about how the advisor or the platform is doing, where is it in the NIST survey, where how qualified folks are at the advisor. You want to really make sure that your board of directors is aware of that. How often are you being attacked? I saw someone's map that showed the amount of attacks that go on a day-to-day basis, and you almost couldn't see the map because there were so many attacks going on. And I do think that the SEC I think, I would expect that cyber is probably going to be before climate. Matt, do you have any thoughts on that?
I mean, I think it's really important. From a BDC standpoint, what I think is really important here is the disclosure requirements as part of the proposal. So if there is an attack, right, it's you may have to disclose it in your financial statements. Not only that, but it may not be an attack that happens with you, like you talk about externally managed. BDCs, like, well, what happens if something happens at your service provider?
Yes.
And it's that sort of due diligence, that robust due diligence that's already out there, but it's stepping it up to the next level. And I think this rule could have some pretty broad impacts to BDCs and also the investment management, the mutual fund industry, private funds as well.
And there's some real issues around how you would disclose it, and the fact that the BDCs are on both ends of this, one having to report it and then having to decide what, even if you're reporting it from an advisor standpoint, what do you have to disclose? It's really kind of vague, and hopefully the SEC has gotten that kind of input and will ultimately take that to heart, because I do think that could put us in a really kind of a bad situation.
And the time period to report it, right? You're in the middle of a cyber attack. You're trying to figure that out, and then you have to get to the SEC within a very short time frame. I mean, it's a big rule.
Yeah, I just chalk it up as, I think most boards say it's lower probability, but I characterize it as high severity.
Yep.
Nobody wants their company to be on the front page of the New York Times or the Wall Street Journal because of this issue. And you run that risk, so you got to pay attention to it. And we can all say, well, it's probably low probability, but if it does happen, that's a problem.
So just going on to, that's everybody, it should be on every board meeting list as far as what's happening, if there's a different topic to talk about. But and you've seen the SEC also come out with the vendor requirements. I do think that part of that is basically making sure, and I don't know, Cindy, if you've got any thoughts on just how you guys respond to cyber. I know that law firms are now getting audits and required to explain how we deal with cyber. I don't know if you guys are getting the same questions.
Well, it used to be the business professional have to answer due diligence questions, and now as our ID department become like in the focal point, and I mean most of our clients actually send us like lists of questions about like how do we protect client data, that cybersecurity and everything. We are joking about that we will need like add 2 full-time people just to answer those questions, just based on the current request from clients. And then if the SEC proposal with the vendor due diligence goes through, that will be another nightmare. And I mean, yeah, we are really concerned about that increased burden imposed, on the service provider in terms of all those due diligence questions. But you're absolutely correct. IT security, cybersecurity is right now, is every day we're getting requests from clients.
So just to go on to exemptive relief, you've heard us reference it a couple different times. The question that was going to be posed in the polling is what next? We've got co-investment, we've got the multi-class. What are people looking for now? And if we could get that question up, and then maybe we can talk a little bit. I mean, folks really want to refine the co-investment to include different sleeves, different sub-advisors, that type of thing. Oh, I missed one, sorry. The answer to whether the board wants to continue doing some in-person and some Zoom calls, the answer to that was 100%. So we went past that one. As far as the incremental relief, anything you see that would be helpful, Stephanie, for folks on the relief?
Yeah, I mean, I think this just, if you look back to exemptive relief when it was first granted all those years ago, to the Ares Apollo relief, which was much more complicated, and really opened the door for a lot of, it really addressed a lot of the complexities in co-investments. So I think, looking at the polling here, I think it just shows that, regardless of where the numbers are here, that, investing and co-investing is incredibly complex. Whether you're talking about a fund, multiple funds that you, the platform, manage directly, or whether you're bringing in sub-advisors, or you have different sleeves because, you might have a team internally that has a different focus. It just goes to show how incredibly complicated co-investing is. So I think, the industry, as it should, keep pushing the SEC, because I think that is only beneficial to shareholders. Now, going back to a comment I think Matt said earlier about like how quickly anything is going to change, that I have no idea. Like you said, there are things, I think even in the temporary relief that became permanent last year, I think to a lot of companies, a lot of BDCs, that was obvious. Well, of course we need that. This is really good. This is how the investing world operates. But it took a long time to get to the temporary relief stage. I think the pandemic pushed the SEC on that. I don't know that they would have gotten their temporary relief without the pandemic. But then once they even made it permanent, there was a process, an administrative process to go through that delayed a lot of companies getting that relief. And I think that just goes to show that even things that the SEC was okay with, kind of got stopped for a while to get through another administrative hurdle. So I think that goes to show you that anything that, even if it is good for shareholders, may take some time.
Which I think what Matt was
Right.
Alluding to. So I'm going to jump to mergers and JVs. And Jonathan Bach, who was a little late, apparently is here. And so I'm going to try and throw him the question. I don't know if he wants to come forward or answer from where he is.
I said, yeah, I'm back here.
So I can't see you. You want to come into the front of the room, and where do you think the M&A activity is going, and what kind of other issues do you see, if any?
Well, it's a pleasure to be here. One thing I learned is flights, when it comes to maintenance, they're not delayed just once. So I really appreciate that. In terms of M&A, it's really difficult. Having been a part of them in the past and also kind of looking to the future, what you find is there's quite a bit of value that's stored up in the management contract. And the manager wants the value for that contract. So how do you solve for it? There are some ways, but as you start to look forward, you're finding that now more and more managers are recognizing that the funds can be raised in a multitude of channels, and so they're starting to look at the non-traded route much more than they would trying to acquire. My opinion, it's possible there'll be more, but there really needs to be a significant reason for the manager to give up that value. And it's hard. It's hard. Hopefully that answers your question.
Anybody else?
I think what Jonathan said is very spot on. I would say affiliate mergers is in a slightly different category.
Yep.
We've seen a number of those. They've been generally well received in the marketplace. There's usually significant investment overlap, more economies of scale. It's a synthetic equity raise for the public BDC buying the non-public BDC. So when you think about it from that standpoint, I do think there's industrial logic to those kind of affiliate mergers. It provides liquidity to that non-public shareholder base. There's clearly questions, but the amount of hurdles that you have to overcome are different. One of which, to keep it simple, is the portfolio. You're probably not going to have any conversations about fair market value. Same manager, right? Applying the same methodology, there's not going to be any adjustment to fair market value during due diligence. Same management team tries to buy a non-affiliate portfolio, I can guarantee you they're not going to agree on 100% of the portfolio marks. So they're going to say, oh, we need to adjust. So everything that Jonathan said is spot on, but in addition to that, that's the reason why affiliate mergers are more logical and straightforward, because you don't have that question about what is fair market value in today's marketplace, where you do with a non-affiliate. So I think that, so there will be more mergers, but more affiliate, because the non-affiliate, the ones that have been sold have been a little generalization, have been more subscale, and the decision was made by the board that it was time to, the shareholders would be better off maybe part of somebody else. Each one has their own story and everything else, but if I had to make an umbrella comment, that'd be my generalization there. And most of those type of entities have been merged out. A lot of these entities that are around now are part of very large platforms, and the shareholders, even if the public vehicle doesn't have the market cap of $5 billion, they have the benefit of co-investing for billions of dollars, but their portion is X% of each deal because of the co-investment rights, et cetera. So the shareholders benefit from that larger platform, so it's not really driving that. The entities that were merged out were the entities that were not part of large platforms, and they didn't have the same benefit of the funnel of seeing as many deals. And so as a result of that, there was performance question marks, and in some cases, the performance was not as strong as others. And my view on that is any industry should have mergers. The BDC space should not be exempted from that. So as a result, of course, there's been some mergers. Will there be some more? Sure. But what Jonathan said makes it very, very difficult to get anything done.
Well, Jonathan, we've already tackled the first question that I was going to ask you. So, but as we come to a close on today's session, where do BDCs go from here? What's next? Where's the growth?
Well, Cynthia, I think it's probably fair to say your leadership and your firm's leadership, think about what we were doing here 10 years ago. And I was clearly in a different job, and I couldn't have imagined, how different things are, or couldn't imagine how big the space has become. I do think as you start to see the level of innovation that's coming, whether it's from large or small, it doesn't matter, internal, external, the general need for this asset class and what it produces in the form of stable return is always going to be there. And more importantly, as you and other policymakers continue to push this space in that right direction, I think it's only going to get that much larger. And so every time we ask this question coming back, and I know we've been doing this for 10 plus years, Cynthia, I'd say that in an additional 5 years, you'll see another doubling of assets. Now, where the capital's raised and in what channel, and retail, institutional, and merger, this, that, it'll all come in different forms and fashion, but by and large, it will be a significant growth industry, and there's not much that will slow it down, even in a recession, in my opinion.
Right. Anybody else?
Yeah, I think having the ability to work with Bach on some very interesting and creative mergers over the past couple of years has been great. I think we'll continue to see some of the mergers. One thing that I was going to say from a creativity standpoint, or where we think the industry is going, I mean, there's certainly more and more creative structures. We started out with just the JVs, and now you're seeing a lot of specialty lending vehicles. You're seeing more entities that want to be in the opco space, but they're subs. And one of the fun things about working with Bach is you get these crazy calls every once in a while, and you'd have an awesome idea, and just kind of working through those. So what I really like about this space is the innovation and really the genuine intellect on how to be a better operator and provide better, safer returns to the investor. And I think people will continue to find ways and look for opportunities to do that creatively.
Matt, that's a credit to you and Al and Cynthia in terms of as these ideas bubble up, probably 90% of them you can say bad idea. But generally speaking, it's working in partnership. So you're right, there is quite a bit of creativity, and you can see that in this room today.
I didn't say no to 90, did I? You were less than that.
You were quite a few.
No, I do think that the management teams, the advisors, the folks who work for them, really have basically created this industry that has that creativity. And having worked for banks and savings and loans in my way past, the management teams really make the difference here and make it exciting to work for the industry. So that's going to bring us to a close. I don't know if there's any questions. This was a little bit of a round robin. I think we're going to be talking about more of these things in a lot more depth, but appreciate everybody joining us for this. Any questions, or everybody wants to move on to the interactive sessions? I'm sure there's another question I'd come up for Jonathan. Come on. Anyway, so those sessions, there's 3 sessions are going to be run concurrently. So and there'll be you can go to there'll be the first one, and then there'll be another round. So you can choose 2 of those. Anyway, and then obviously there will be the networking session later this evening. But thank you everybody for joining us. Hopefully you found this interesting, and we'll see you around the conference.
Thank you.